Okay, welcome on board everyone. Happy Friday. This is Ilian Yotov welcoming you aboard. I'm the founder of allthingsforex.com and a host of a popular program there, the All Things Forex Trading Room. We finally launched it earlier this week, and I would like to invite you to check it out for yourself. Live on a market analysis, Monday through Friday for 1 hour each day. And we also have some other interesting things as far as educational content and research content on allthingsforex.com for our premium members, so make sure to check it out. The website is www.allthingsforex.com. Those of you interested in my book, it's called The Quarters Theory. It is available everywhere books are sold, including on fxstreet.com. Speaking about FX Street, I'd like to thank them for hosting this series of webinars. And what we're here today is to prepare for the top 10 spotlight economic events that, in my opinion, are going to be the biggest market movers in the trading week ahead. We've had a very interesting trading week so far this week. We've had some record low interest rates being reached in Australia. Reserve Bank of Australia earlier this week reduced their interest rate to a new record low, 2.75%. We've had the Reserve Bank of New Zealand coming clear as far as admitting that they have intervened to curb the strength of their currency, the New Zealand dollar. We had a very strong move for the dollar starting yesterday, continuing today in today's trading session. We have the dollar-yen pair above 100 yen for the first time since, 2008, even above 101 yen already. And so it's been very interesting. Mr. Druckenmiller, George Soros' chief strategist in the early 90s, who helped make that $1 billion on a British pound trade, literally being published, his statement being published yesterday on Bloomberg, warning about the Australian dollar coming down, potentially coming down and coming down hard. He said, literally hours after that was published on Bloomberg, the Australian dollar did come down and did come down hard. And it's now at parity with the US dollar. So very, very interesting week. Is it going to be as interesting next week? I think so, actually. We'll have a sequence of important economic data, and to the forefront next week are going to come the main gauges of economic activity and growth from the Eurozone and also from Japan. Both of these economies mired in recession, especially the Eurozone, as you know. Very, very important to see, is the Eurozone turning the corner? Is it going to continue to contract in the first quarter of 2013? Or are we going to see the Eurozone managing somehow to return back to growth, even if it's a minimal one? This is going to be the same question that we'll be asking when it comes to the Japanese gross domestic product report, which is coming up also next week. Is the Japanese economy also managing to grow now, especially after we have seen the unprecedented amount of quantitative easing, unconventional monetary policies and measures that are taking place there in Japan? Are they able to spur economic growth? Because in the previous quarter, the Japanese economy did not grow. The GDP reading was exactly at zero. At least it did not contract, but it did not grow. So those are going to be the two main spotlight events of next week. But the first one, in between those two events, we're also going to see some important data from the United States. The first of the top 10 events for next week I've chosen to be the retail sales report. It's always an important gauge of consumer spending. Consumer is a very, very important, significant part of the U.S. economy because our economy is mainly services related. So consumer spending is very, very important. For the U.S., the April retail sales are expected to increase by 0.1% month over month. Now, that is a small increase, but at least it is an increase because in the previous month in March, the retail sales in the U.S. dropped by 0.4%. this report is going to be one of the economic reports that we can add to the list of positive economic data from the U.S. And I think that this is going to be important because as we now are trying to gauge the condition of the U.S. Economy, that's going to be very closely related as far as the future moves by the Federal Reserve. Some in recent months have begun to price in that the Federal Reserve, because of the improvement in the U.S. economy, that the Federal Reserve is going to take that first step towards tightening monetary policy sooner rather than later. And I think that the dollar will continue to benefit from such expectations going forward. If we are seeing the market beginning to aggressively price in the weeks and months ahead expectations that the Fed is going to take that first step. And I've been saying this all along for months, so those of you who listen to this webinar on a regular basis know what I have been saying for months, and that is the Fed is not going to quit cold turkey with their quantitative easing and keeping rates at a record low, practically 0%. The first step, in my opinion, that the Fed is going to take is the Fed is going to consider reducing the size of the amount of asset purchases that they're making at this point. The bonds purchases, mortgage-backed securities that they're buying to the tune of 85 billion per month. In my opinion, that's going to be the first step towards tightening. So as soon as the market begins, and I think the market's already started somewhat to price these expectations, and it is reflected in a way that the dollar is trading versus some other majors out there. Now let's take a look at the euro-dollar pair to give you an idea of, to help you visualize what I'm saying. After the European Central Bank last week announced that they're going to reduce the benchmark rate to a new record low, 0.5%, the initial market reaction was very interesting because we saw the euro actually strengthening as a result of that announcement. And it wasn't because of expectations that the European Central Bank will continue to cut rates. It was because of expectations that the European Central Bank will have to do even more than just cutting rates. And that's including some unconventional monetary policy easing measures. So now we're finally seeing, so the euro strengthened as in the aftermath of the European Central Bank's announcement. But we're finally seeing the market aligning, the euro-dollar exchange rate aligning with underlying fundamental backdrop, which is still rather negative for the Eurozone. We know the Eurozone is mired in recession. We know that the European Central Bank is more than likely going to consider further easing, some other unconventional measures, perhaps even as early as their next month's meeting. And we're seeing the euro, rightfully so, being pushed under the $1.30 mark today as we speak. It is approaching a very important level of support, which was a little bit below the $1.30 level. Just a couple of weeks ago, we saw the euro finding support in the $1.29.5 area, $1.2953. So heading into next week, it's going to be very important to pay attention to this particular price level because it is the level of support that could really tell the story in a way that if there is a successful, decisive break below this support area, then the euro is going to get out of this channel that has been stuck within for the last, like 4 or 5 weeks or so. And it's been a channel, it's been a range between $1.29.5 and an important level in my quarters theory, which is the $1.3250 large quarter point. And as you can see, it's $1.3241 was the high here recently, a couple of weeks ago, which is a little bit below the large quarter point, $1.3250. So that level, that large quarter point serving as a level of resistance and the top of this weekly channel. If you want to consider what could be the next areas that could be challenged, if the euro were to break below $1.2953, then just a little bit below that level, there's a double bottom support right here in this area, which was $1.2875. $1.2875. So a break below $1.2953 is going to quickly send us to $1.2875. this is going to be another important support level before the euro then transitions to complete the quarter to $1.2750, and that will be the quarter between $1.30 and $1.2750. In my quarters theory, I propose that currency exchange rates do not, and prices in general, do not fluctuate in a random manner, but rather in an organized, systematic manner, fluctuating between the large quarter points of each 1,000 pip range. Each 1,000 pip range I divide into 4 equal parts, or 4 large quarters of 250 pips each, and I propose that the exchange rates fluctuate there between the large quarter points. Every significant price move occurs from one large quarter point, targeting another large quarter point. So if the euro breaks decisively below $1.30, which is the large quarter point there, breaks below the support of the $1.2953 and $1.2875, then the door is going to be wide open for the euro to complete this entire large quarter of 250 pips that we're beginning to work on again today with the decline below $1.30. And that's the large quarter of 250 pips between $1.30 and $1.2750. And if next week's the Eurozone economic data does not instill any confidence that conditions in the euro area are improving, then obviously that could continue to weigh on the euro, and it could accelerate the euro's losses further into. Wait, hold on one second. What happened here? I think I just pressed the wrong button and it took me to the end of my presentation. Not so fast. Let's go back. So that's the implications of paying close attention to the Eurozone economic data next week, because if we continue to see doom and gloom from the euro area, I think that that's going to really create, if it's not visible to traders now, it's going to make it even more visible to traders next week to compare economic conditions in a Eurozone and economic conditions in the U.S. And it doesn't really take a rocket scientist to figure out here that the U.S. is looking much, much better than the conditions in the Eurozone. And ultimately, that could trigger even more expectations. It could increase the odds that the European Central Bank could consider further unconditional measures to stimulate the economy there, to create growth, and ultimately we could see the euro coming under additional pressure. That, I think, is going to be the catalyst for the euro to be pushed further into the $20s and possibly complete the quarter to $1.2750. So the first of the important Eurozone economic data next week is going to be a forward-looking index of economic sentiment, the ZEW index. And this report is coming up on Tuesday. It is expected that for the month of May, the index is going to register a reading of 38.5, which is going to be a little bit of an increase from 36.3 in a previous month. Now, earlier this week, we saw some surprisingly positive reports from Germany factory orders better than expected, German industrial production better than expected. There's some signs that industrial activity may be picking up in the Eurozone's largest economy. But the problem is, when it comes to the GDP report next week from the Eurozone, is stronger economic activity from the Eurozone's largest economy, which is Germany, is it going to be enough to lift up the overall GDP figures and estimate for the first quarter for the entire Eurozone? That's the big question. But starting with the first of the important reports next week from the Euro area, this one could be a little bit better. At least the consensus forecasts are pointing to a little bit stronger reading for the economic sentiment index from the Euro area. That's going to take us after that on Wednesday to a sequence of important economic events from the United Kingdom. And we saw earlier this week that the pound was having some problems as far as overcoming the resistance at the $1.56. It has pulled back significantly since that level in the last couple of days. The jobless claims and unemployment rate, of course, are the important measures of labor market conditions in the UK. We have seen the Bank of England sitting on the sidelines as far as their monetary policy is concerned. No more quantitative easing, and no hurry for them to announce further quantitative easing and expansion of their asset purchase program, which, as I explained since the GDP report on April the 25th, which I was anticipating with a great excitement, we didn't see the United Kingdom's economy actually contracting. They managed to avoid an unprecedented triple-dip recession. And after the April 25th GDP report from the UK that showed that the economy avoided the triple-dip recession, I explained at that time that this dramatically reduces the odds that the Bank of England is going to be in a hurry to do further quantitative easing and expanding their asset purchase program. So the pound, as I said at the time, if the Bank of England is not expected to ease monetary policy further, the pound is going to become a viable alternative, and it's going to start attracting even more bids as an alternative to currencies whose central banks are committed to aggressive monetary policies and quantitative easing and so forth and so on. And it's the if you take a look, for example, at the compare the European Central Bank expectations, where I think that the market's pricing in expectations that they're going to ease more, and if the Bank of England is expected to sit on the sidelines, then the pound could continue to attract more bids versus a currency like the euro, versus the Japanese yen. As we know, the Bank of Japan is not going to stop their unconventional policies and aggressive quantitative easing anytime soon. The Fed has already committed and reiterated in the last couple of weeks its commitment to continue with asset purchases with record low interest rates. So I think that the pound could continue to find bids going forward and benefit from that. Let's take a look at the consensus forecasts for the for this economic report coming up. The unemployment rate is expected to increase, actually, from 7.9% to the 8% level. As far as the jobless claims, let's see here. The reading expected is minus 3,100. So minus 3,000 compared with minus 7,000. A little bit of a smaller drop in the first-time claim for unemployment benefits. So overall, I actually have Reuters consensus forecast saying that they're expecting unemployment rate to increase to 8%. Others are saying 7.9%, no change in the unemployment rate. So we'll see whether the jobs report from the UK is going to be one of those reports that increase the optimism levels, if you will, as far as the conditions of the United Kingdom's economy. Certainly, we've seen better than expected readings from the manufacturing and services indexes. We've had the economy avoiding a triple-dip recession. So things are starting to look a little bit brighter when it comes to the UK. And yesterday, the Bank of England even said in their statement following their interest rate announcement that there is a nascent economic recovery taking place in the UK. Now, that might be a little bit too optimistic for some people, but there are some signs that there is some recovery taking place. And you know what's really interesting about the British pound from the perspective of the Eurozone's expected recovery? Because if the market is, the reason why the euro was bid in the aftermath of the European Central Bank's announcement was because of the market's expectations that this time the European Central Bank is going to get really active. They really are going to do whatever is necessary to spur economic growth. They're cutting rates. They're considering additional unconventional monetary policy measures, perhaps even similar to the Bank of England's funding for lending type of a program that spurs lending to small businesses, individuals in the Eurozone. That's going to help if the program is successful, of course. That should help with creating activity, creating economic growth in the euro area. And ultimately, if there is such developments that if there are such developments that take place in the months ahead, it's not going to be instantaneous. Obviously, the effects of these monetary policy measures are going to take months to reflect in the real economy and the actual economic reports that come out, let's say 6 months from now. But with the markets being forward-looking, that's a bit of an optimism that has managed to help the euro a little bit. Not right now in the last couple of days, but last week in the aftermath of the European Central Bank's announcement. But again, going to my point of, as far as the pound actually becoming an alternative, and it could also benefit from the recovery in the Eurozone because the United Kingdom's economy, largest partner, trading partner of the UK, is the Eurozone. And so the recession in the Euro area also weighs on the UK. If the Euro area now manages to get out of that recession, then the UK economy is going to benefit as well. And so the pound could benefit from that also. As far as economic backdrop is, and fundamental backdrop is concerned, here is the daily chart of the pound against the dollar. This is the level that I was referring to earlier, that the pound was having some issues as far as overcoming earlier this week. It made several attempts to break above the $1.56 level. $1.56.05 was a resistance there from May 1st. Tested it on that day, did not break above $1.56. A couple of days later, it reached $1.56, still no breakout. The following day, $1.55.97, third attempt, still no breakout. Earlier this week, $1.55.90, close to $1.56, but not enough to break above it. Yesterday, we had the pound approaching that $1.56 area resistance again for a fifth consecutive time in just the last week. $1.55.87 was the highest we got yesterday, and then we, of course, had the strong move for the dollar. We got the pound put under pressure, and the sell-off in a pound-dollar pair continues even further. Today, it is now reaching $1.57. 63 as an intraday low. This previous resistance area, which was $1.54, was also broken below. We had a little bit of a hesitation around that level, but the pound was pushed even lower below that level, so that's not going to serve as a level of support anymore, obviously. We are on our way to the important level in my quarters theory here, which is the large quarter point at $1.5250. I will be watching next week that area for potential support that the pound could find. This $1.5250 area has been also the bottom of the range for those of you who attend my weekly webinars for a long time. In a span of the last year and a half, the pound-dollar exchange rate has been confined just until recently when the pound broke below the support in the bottom of that range. But the bottom of that range was roughly the large quarter point area at $1.5250. We had some numbers ahead of $1.5250. We had some numbers below $1.5250. But in general, it was the area of the large quarter point there that served as the bottom of the range. And the lowest low was a little bit below $1.5250. It was $1.5232 for those of you who have a little bit of a longer-term memory. So you probably remember that level, that area serving as the bottom of that channel. So $1.5250 area will be, I think, an important area of support. If the pound breaks below it, then recent support level, which is $1.5195, the support from the 23rd of April, is going to be the next level that we could challenge. If the pound does not find support within this area, I think that it probably will, depending on what happens next week with the UK data, employment report, and then just an hour after that, we're going to see the Bank of England's inflation report, which I'll talk about in a minute. So a couple of important events for the British pound that are coming up on Wednesday, I think that the door here is open for a move to $52.50 area. And depending on what the pound does in that support area, let me just give you some examples so you don't really think I'm talking out of my head here without giving you specific price levels. $52.32 was a support level. $52.76 was a support level. $52.85 area was a previous support level as well. All of these numbers are around $52.50. Like as I said earlier, they're either ahead of $52.50 or a little bit below that level. So I think that this is going to be an important area that could be challenged. And depending on whether the pound finds support at that level, we can anticipate then a move in a bounce higher. After all, this is simply just a price correction of the pound's rally here in the last couple of months versus the dollar. We're seeing a price correction that's taken place with the pound correcting some of its gains. I think that if the $52.50 area serves as the area of support, we could easily see the pound attempting at least to bounce higher again and at least make a move to $55, maybe even challenge the resistance at the $1.56. A big event next week for the pound is also going to be, as I said earlier, the Bank of England's inflation report. This is the bank's official assessment of economic conditions and inflation. Some of policy makers there, the Monetary Policy Committee at the Bank of England, have been voting against an expansion of the asset purchase program, against more quantitative easing. And one of the reasons is because they're saying that inflation is still at 2.8% in the UK, which is a little bit greater than the 2% desired target level. So it's going to be important to see, as far as pricing in expectations as to whether or not the Bank of England will do more easing, is to see if the Bank of England is expecting inflationary pressures to continue to be above target. If they continue to be above target, then in some way that could keep policymakers from doing more quantitative easing. But I don't really think, personally, that the 2.8% year-over-year level of inflation in the UK is the reason why they're not doing more quantitative easing. Because those of you who follow the Consumer Price Index reports from the UK would remember that not too long ago, this inflation gauge was even above 5% level. Now, granted, still it is above 2%. It's at 2.8%, as the previous month's report showed. But it's significantly below where it used to be. And when inflation was around 5%, that didn't stop policymakers at the Bank of England from expanding the size of their quantitative easing program. Did it? No, it did not. So I don't think that inflation really is the reason why they're sitting on the sidelines. I think they were waiting for the GDP report. They were waiting to see on April 25th whether the United Kingdom's economy avoided a recession. It did. And so, as I said at that time, there's just no reason at this point for them to be in a hurry to do more easing. And I think that they're not going to do more easing until at least the new Bank of England governor, Mark Carney, takes his seat, which is going to happen in July. So we're looking at least a few more months, a couple of more months, of no easing by the Bank of England. And so unless this inflation report expects that inflation is going to really increase back to 5% level, I don't think that the market's expectations will be really impacted. As far as expectations, the Bank of England's not going to do more easing for at least another 2 months. So there's a question from one of our listeners here asking, do you see the pound-dollar pair rally from $1.4829 to $1.56 as a 5 or 3 waves rally? Okay, well, let's take a look at the exact number of trend waves that Ron is asking. Let's see here. Now, it might look like a 3-wave rally, but what I do with my version of the classic Elliott wave theory, and for the lack of a better name, I call it the quarters theory trend waves, but obviously it is based on the classic Elliott wave theory with some variations and some significant differences in the way that I count the number of waves. For example, I do not call the price corrections, I do not give them an actual number. I still consider them as a part of the trend wave development and the trend wave sequence. But the biggest problem that Elliott wave traders have, classic Elliott wave traders that is, including myself, and that's why I had to develop a methodology which helps me as far as the proper wave count. This is the biggest challenge and the biggest problem for Elliott wave traders. And as a famous saying, if you put in a room filled of Elliott wave traders, if you ask them to count the number of waves, every single one of them is going to count them differently. And that's not good. It's not good because if you do not count the waves properly, then you would not know what stage and what phase of the trend progression you attempt to get involved in that trade. And that's very important, because if you're in the beginning of the trend, then that's great. But if you're at the end of the trend wave progression, then that's a problem, because you could become the victim of the reversal. Your stops are going to get triggered very easily. And so that's the biggest issue that Elliott wave traders, proper wave count, it's always been a problem, and it always will be. But if you follow my quarters theory trend waves methodology, there is no doubt as far as the actual number of waves, because the way that I call it is a trend wave always ends, a trend wave sequence always ends with what I call a reversal trigger wave in the opposite direction, and it always starts with a reversal trigger wave as well. So it's very important to find these first reversal trigger waves that I call them. So in order for us to find out what's the proper wave count here, and with the risk of this becoming more of a training session rather than an outlook on the economic events of next week, let me go very quickly here. I would have to go with finding the most recent reversal trigger wave in this particular trend wave sequence. And it looks to me that this most recent reversal trigger trend wave, let me space these guys here, was actually this one here. So you had a sequence here, one, let's say this was a reversal trigger wave in the opposite direction. So you had a bullish sequence here. One, this is correction following, again, this is not a wave. This is the reversal trigger bullish wave one. Now, wait a second, was it? No, it wasn't. This was a bearish trend wave sequence here. So you have a bearish wave, you have a price correction here, you have an attempt for another bearish wave here, which fails. Here's your first reversal trigger wave that occurs here. That's number one. This is the correction following that wave. This is wave number two. This looks like a correction following it, but unfortunately it breaks below the low here, and so this becomes a reversal trigger wave in the opposite direction. So immediately after that wave, you have a strong move higher, and so you have a first reversal trigger bullish wave here. Then you have a second wave that's attempting here. It only lasted for 1 day. A new reversal trigger wave that zeroes the counter again here. And so you have a reversal trigger wave, you have a correction, you have another bearish wave here, and now you have a first reversal trigger bullish wave, and a price correction here, an attempt for a second bullish wave which fails. By the way, if you follow my quarters theory methodology and the quarters theory trend waves, you will know that the trend wave failure is in most instances followed by what I call a reversal trigger bearish wave. or reversal trigger wave if it were bullish or bearish wave. So in this case, you have a first bullish wave that develops here. It reaches the high at $1.5605. You have only, let's see here, you have only 1 day of a price correction. And then on Wednesday, you have an attempt for another bullish wave to target that high of the first bullish wave. Unfortunately, the second bullish wave fails. It doesn't break above $1.5605, so the trend wave sequence comes to an end. And as a result of that second bullish wave failure, you have a reversal trigger bearish wave that is now taking place in the last couple of trading sessions. I hope that that answers the question. You see, it didn't take forever for us to count the number of waves. It's very clear where we are here as far as the trend progression. Second bullish wave failure leads to a reversal trigger wave in the opposite direction. And so reversal trigger bearish wave now starts a bearish trend wave sequence. Now, this bearish trend wave sequence, however, as I said earlier in my analysis, could be just a corrective type of a sequence. We had, generally a bullish move here that the pound was able to produce in the last few months. So it is a bearish trend wave that we're in right now, but this could be just a corrective trend wave sequence. So that's what's going to be important, as I said earlier, for me, is to see whether the pound finds support, whether it's a $1.5250 area or somewhere else a little bit below it, where this bearish corrective sequence ends, and then we'll see whether some bullish waves are going to start to be established if the pound finds a baseline support from which we could head back up to $1.55 and possibly even challenge $1.56 level. Hope that answers the question as far as the proper wave count. And now let's go move forward with the top 10 economic events. We're running out of time here, and I'm trying to cover a lot of ground. Big event of next week, Eurozone gross domestic product report. I think every currency trader should watch this release. It's coming up on Wednesday at 5 a.m. Eastern Time. I already explained earlier. If the Eurozone continues to show recession, this, by the way, could be the third consecutive quarter of a recession. Remember, the UK went through the same thing. The UK was having some 3 consecutive quarters of contraction. We could see that in the Eurozone as well. At least for now, the consensus forecasts are expecting the flush. This is a preliminary flush estimate for the first quarter GDP in the Eurozone. The consensus forecasts are expecting another quarter of contraction, a little bit less than the contraction in the final quarter of last year. In the fourth quarter of 2012, the Eurozone economy contracted by 0.6%. For the first quarter of 2013, the forecast is a contraction by 0.1%. Obviously, if that's the case, that's another quarter of contraction. This could accelerate the market's expectations, could accelerate the pressure on the euro, and increase the odds that the European Central Bank should consider to do more. The pressure on the European Central Bank is going to be on to do more if we get to see a contraction in the first quarter. So I think that, as I said earlier, I think this report next week is going to either make the transition of the euro-dollar exchange rate from the $1.30s back into the $1.20 successful or not. And it will depend, that transition, on what the Eurozone GDP report shows us. Again, the consensus forecast is for a contraction of 0.1%. However, if we get to see a positive surprise, the same way we saw that stronger than expected GDP report from the United Kingdom, the 0.1% contraction, if it's not there, if it's, let's say, 0% flat, at least not contraction, or 0.1% increase, 0.1% growth somehow that the Eurozone manages in the first quarter, then that's going to be, I think, a positive for the Euro report. If the GDP report surprisingly does not show that there is going to be, that there was a contraction in the first quarter. So again, depending on the Eurozone GDP report, in the outcome of it. The transition from the $30s to the $20s will be dependent on that. And as I was showing you earlier with the Eurozone, with the euro-dollar pair, there's a number of support levels there to watch. Depending on the outcome of these reports, I think if the GDP report is negative, we could see the break below $59.53. Heck, we might see the break below $29.53 even today because the euro is already getting close to that level. It already reached as low as $29.56. I don't think that I hope you don't think that this was a coincidence, by the way. This is the support level that's being approached, that's being challenged. If it breaks at $28.75 would probably be the next one in line, and then $27.50. You didn't really think that this was a coincidence either, did you? Some identical support levels here at the $27.49, and then $27. Let's see here, next to $27.54, and then a third one, which was at the $27.43. Now, they might look to some people as completely random numbers, but anyone who's familiar with my quarters theory knows what the important level there was that was being challenged. It was the large quarter point at the $27.50, which served as an area of support. 3 times it was tested, and it was not broken below decisively. So that's what I'm saying. $27.50 is going to be an important area of support for the euro that could be challenged if these interim supports at $29.53 and $28.75 are taken out. And by the way, $28.75 to me is not a coincidence either, and to those familiar with my quarters theory is not going to be a random number, because $28.75 is the exact half point, which is an important price level within the actual large quarters of 250 pips. The half point is always 125 pips from each one of the quarter points. And $28.75, coincidence or not, happens to be that type of a price level. It's the half point of the quarter between $27.50 and $1.30. Okay, so big event next week from the Eurozone with the GDP report. Moving forward, we'll see the U.S. industrial production on Wednesday. We're expecting to see industrial activity at minus 0.1% contraction, basically month over month of 0.1% after rising by 0.4%. So that could be one of the negative reports from the United States next week. Wednesday evening, the second big event of next week, which will be the Japanese gross domestic product report. As I said earlier, the market is going to be watching as to whether or not Japan is starting to show some promising signs. After all this unprecedented quantitative easing by the Bank of Japan, the pressure on the Bank of Japan to do more, to weaken the Japanese yen, to help exporters, to spur export economic growth, this is what we're going to watch next week to see whether the Japanese economy is returning back to growth. And by the way, looking at the consensus forecast, it looks like the market analysts are expecting that that's going to be the case. 0.7% quarter-over-quarter growth in Japan in the first quarter of 2013 compared with a flat 0% reading in the final quarter of 2012. That could be a very positive report from the Japanese economy. However, we could start seeing the signs that these unprecedented monetary policy easing measures are starting to have an impact on the economy, on economic growth, on the account balance. Actually, yesterday was an important report from Japan. With the current account, we saw the Japanese current account returning back to surplus, which was a positive report. In a way, we need to start paying attention to these Japanese reports, because if we start seeing some significant signs of improvement in the Japanese economy and economic activity, then that is not going to put any kind of urgency for the Bank of Japan and the government there to continue pressing further with more aggressive measures. If they've already done way too much than even what the most optimistic market analysts were expecting. But if these measures were not working, then obviously they have promised to do even more. If they're starting to work now and the economic data like the GDP report and the current account balance begin to show the positive impact of these measures, then there's not going to be an urgency or a need for the Bank of England, the Bank of Japan to continue to do more and get even more aggressive. And so the Japanese yen could start to strengthen if the market's expectations that policies are going to get even more aggressive in Japan begin to be reduced. So that, I think, would be the implications of further improvement in the Japanese economic data. For the time being, the dollar is really enjoying the breakout above the resistance level. Earlier this week on my All Things Forex Trading Room program, I pointed to our members that there was an impending breakout that was coming up. All of the signs were there. I would very quickly help you visualize what I meant by that. We had a all right, hold on one second here. We had a symmetrical triangle that was developing in the dollar yen. And I drew the same thing a couple of days ago in my program to show our members what I meant by that. You can see these new highs that were descending highs, and at the same time we had ascending lows, which is a symmetrical triangle. It's one of those patterns, price patterns, that is an early warning signal of an impending breakout. And so we were anticipating that there's going to be a breakout, that there's a breakout type of development that's taking place. And sure enough, yesterday we had the break above the resistance here, above this trend line. We had the break above the previous highs that were a little bit below 100 yen level. And obviously, this is an important technical development, very bullish technical development for the dollar against the yen. The next level, you probably need to go back to 2008 to find some resistance levels. So far, the dollar yen today is reaching as high as $101.74, which is only 75 pips or so from the next important level in my quarters theory, which is the 102.50 yen area. I think that the dollar yen is eyeing this level, and the only level that could prevent the completion of this quarter between 100 and 102.50 yen now is going to be the whole number at 102 yen. That's the level that I'll be watching next week, 102 yen. If the dollar yen pair manages to break above 102 yen, we're very quickly going to see the completion of the quarter to 102.50, and we may even at that point see the challenge of 103 yen level, where a lot of major banks earlier in the last couple of weeks, strategists there have come out and said 103 yen is the first level that they're watching, followed by 105, and some of them are saying 110 by the end of the year. Deutsche, Barclays, Credit Agricole, Credit Suisse, JP Morgan, if I'm not mistaken, strategists came out and said that's Citigroup. A lot of major financial institution strategists were talking about an impending breakout above 100 yen, move to 103, maybe even 105. And so I think, again, in my quarters theory, I am focused on these quarter moves. So 102.50 is the next level that I'm watching. But the final level within this large quarter that could prevent the completion of the quarter to 102.50 in this case would be the 102 yen level. And so if the dollar yen starts showing some signs of exhaustion around 102, then unsuccessful completion of the quarter to 102.50 could lead to a reversal that takes prices back to 100 yen level, which is going to be the preceding large quarter point. So it's a very, very interesting development taking place with the yen. We'll see whether the transition of the dollar-yen exchange rate from the 90s, which is the current previous 1,000 pip range, into the new 1,000 pip range, the hundreds, between 100 and 110 yen, is going to be successful. And I suspect that next Friday, we're also going to talk about this currency pair and that transition, and we'll follow up and see whether that transition is successful. Another important event from the euro area next Thursday is the Eurozone Harmonized Index of Consumer Prices. I have talked in recent months about the decline in the main measure of inflation preferred by the European Central Bank. Inflationary pressures have been declining in the Eurozone, making it even easier for the European Central Bank to consider further easing, because obviously if inflation is not rising, they can feel comfortable enough to do more easing in the euro area. It is dropping now significantly below the European Central Bank's target level, which is 2%. It was at 1.2% according to the preliminary estimate that we saw a couple of weeks ago, and more than likely next Thursday the inflation gauge is going to be confirmed at that level, 1.2% year over year, significantly below the 2% level. I said months ago that the type of a buildup of deflationary pressures in the Eurozone could also be a significant factor for the European Central Bank to do more easing. And certainly that's what the markets are going to watch for next week, is to whether or not inflationary pressures continue to be significantly below 2%, clearing the way, if you will, for the European Central Bank to do more, and ultimately that could increase the pressure on the euro even more next Thursday. Housing starts is also due next Thursday from the U.S., kicking the housing market sequence, leading us to week after next week, the existing home sales, new home sales coming up. The housing starts are expected to reach 980,000 compared with 1.04 million in the previous month, so they could be a little bit lower than they were in the previous month, but not so dramatically lower. Building permits are actually expected to increase a little bit from 910,000 to 940,000. Housing market's been showing some signs of improvement in recent months, along with the labor market. I've said many times that they're very closely related, so we'll see whether the trend continues there with the housing market. And the final of the top 10 events next week is going to be the Consumer Sentiment Index from the U.S., which was revised higher last month to 76.4. And the preliminary estimate for May is expected to show another slight increase from 76.4 to 77.9. It looks to me like the U.S. economic data for the most part next week is going to be on the positive side, which would keep markets' expectations that the Fed could consider reducing the size of their quantitative easing operations sooner rather than later. Taking the first step towards tightening sooner rather than later is, in my opinion, going to be supportive for the U.S. dollar. This is all the time I have for today's program. Before I finish, I would like to invite you to join me on my All Things Forex live trading room Monday through Friday on my website, allthingsforex.com. You can also follow us on Twitter at allthingsforex is the Twitter account. Thank you once again for attending this webinar. Have a great day and a great weekend, and I look forward to seeing you again next Friday.